Fear begins to grip Wall Street as tech stocks yank the S&P 500 and NASDAQ down from their highs. In today's market forecast, we'll talk about the good, the bad, and the ugly for these large cap stock indices. We'll also check in on our JP and Apple trades and talk about how you might navigate some of these bumpy days ahead. Let's start with the S&P 500. As I start recording this at the market open on Thursday, we've began the trading session with a significant gap down. That's after a sell-off on Tuesday and Wednesday. Now, before we go much further, I have to show you this article that I thought was comical. It's from a rather well-known news outlet, and they're saying that it's this release of Claude Copilot by Anthropic. If you've never heard of Claude or Anthropic, that's okay, because I think this is almost comical that they're blaming the market crash on Claude. It's not like we've been watching for quite some time now this bearish divergence that's been showing up on MACD. In fact, let's zoom out because it goes back even further than this, going all the way back to May of last year. As the market continued to make higher highs, MACD has made lower highs. If you go back and watch all of my previous market forecasts, we've been talking about this. So it comes as no surprise to Tradesmart traders that the S&P 500 is finally pulling back. The NASDAQ is even worse. The NASDAQ had a significant sell-off Tuesday, Wednesday, and is continuing that downtrend on Thursday. Now, that's not to say there haven't been some great trades in the midst of this pullback. A few days ago in the market forecast and even earlier in our Power Trader session, we set up this JP trade. If you join this trade in Power Trader, it hit its target yesterday, putting 1.5 R cash in your jeans, or if you're not familiar with R, that would be about $375 with one of our funded trading accounts. What a great trade in the midst of the market pulling back. Now let's also take a look at Apple. This was also a trade that we set up in Power Trader, and it too hit its target yesterday in the midst of this large market pullback. And also it was a 1.42 R, or translated into dollars, about $350 cash in your jeans. Now, if you'd like to come experience Power Trader, we have a free open house on Monday, February 9th. Go ahead. I'll put this link in the description. RSVP for it. We'll send you a link. You can come and join live, where we have time to explore even more and go even deeper into trade ideas just like that. Now let's go back and take a look at the S&P 500, and we're going to look at the good, the bad, and the ugly as we go forward here. Of course, as we just said, the S&P 500 has been selling off, but there's another way that we can look at this called an equal weighting. Ticker symbol RSP is an equal weighting of the S&P 500, and if we look at the equal weighted version of the S&P 500, you can see that there's no pullback in sight. We've just been going on and up and up and up. And if you're hanging on to some bullish optimism, that's good news for you. But let me also take a look at the VIX. Now, the VIX by the news media is often described as the fear index, which is not exactly accurate. What would be more accurate is to describe the VIX as the cost of hedging or protecting your positions. And as the concern for a bearish market goes up, so does the cost to hedge or protect your portfolio. And that's done with options, and that's what the VIX is tracking. And what I want you to see here, if we overlay the S&P 500 on top of the VIX, you can see that as the S&P goes down, VIX tends to go up. Here's the biggest example of that. Let me actually switch this over to a line chart so you can see it easier. The black line is VIX, and when it skyrocketed back during the tariff scare, the S&P 500 went down. Here's another example back here. In mid-2024, the S&P went down. Here it is on a bumper sticker. If VIX is going up, there's a very good chance that the S&P 500 is going down. Well, let's zoom back in and take a look at what VIX is doing. Current events, VIX is going up. That's bad, but it's maybe not catastrophic, because let's look at how high VIX typically tends to go. We'll just draw a line from where we're at currently back, and we're kind of getting near the upper end of where VIX tends to stop and turn back around. So we could say that maybe we've got a little bit further we go, and then VIX typically comes on back down. The inverse of what I just said, if VIX is going down, what does that mean for the S&P? It's probably going up. So again, this is not ideal that the fear index, or better said, the cost of hedging, is going up, but it's also not the end of the world in my opinion. Now, Here is a problem going forward. Ticker symbol IGV. This is an ETF, an exchange traded fund that tracks software companies. You can see that in the last several months, it has absolutely cratered. Now here's why this is important to look at. I'm gonna go ahead and add the S&P back in here again. And also, this software ETF tends to track with the S&P 500. You can see that generally as one is going up, the other is going up and vice versa until current events where we're selling off like crazy. That divergence needs to get reconciled, and I'm concerned that software is going to pull the S&P 500 with it. Here's why. Going back to ticker symbol IGV by itself, I'm going to put on here the Bollinger Band indicator. And the Bollinger Band indicator, simply stated, is a moving average, the red line, with a standard deviation cloud around it. Typically, it's 2. I'm going to make a couple adjustments to this because I want to show you just how aggressively IGV is moving right now. I'm going to change this to a 50-period moving average and 3 standard deviations, which is incredible. Stocks and ETFs seldom stay 3 standard deviations away from any moving average, let alone the 50. And here we are. We're just now today coming back into it. Yesterday we closed right on the 3 standard deviations. And that's all the while the S&P 500 has not even broke below its 50-period daily moving average. That doesn't happen a lot, where software is very sold off and the S&P 500 is not. And here's why this is important. I programmed a special custom indicator to highlight for us instances where this has happened in the past. Let me pull that up for you. Okay, here's our custom indicator. This is not meant to be pretty, it's just meant to be able to illustrate this point. We've got our daily moving average length at 50, and I want to take a look at any time we are 10% below that daily moving average, but the S&P 500 is not. You can see current events here. We've had a big sell-off, but let's go back and see where that has happened in the past. You've got to go all the way back to 2022. Here you can see a similar instance, and yet it continued on down. This is important because there's a lot of personalities out on social media that are saying, buy the dip, buy the dip. And yes, that's sometimes a good idea, but I have a concern that this is just the beginning of the sell-off of software. Let's go back. It happened one other time back in 2001, all the way back to April in 2002. Again, this is where software was selling off exponentially faster than the S&P 500 and continued on down. But how's that compare to the S&P? You've got those 2 dates in mind. We've got April of 2002, and we've got January of 2022. Let's go back to the S&P 500 and check out what happened. January 2022, market sold off. Let's go all the way back to 2021, April of 2021, March, April. What happened? The market sold off for another year. That's the ugly, my friends. The good, equal weighted S&P 500 could be worse. The bad, the fear index is starting to creep up. The ugly, we've got a significant divergence with software. And in the past, when that's happened, it's pulled the S&P 500 down with it. Now let's talk about how you might trade this going forward. I would encourage you to wait until we find some support. That's going to be the easiest thing to do trading going forward. There's also some intraday day trading strategies. Here's one that I love. It's called the Morning Glory. And I can't teach you this whole strategy because it's a premium strategy that our TSU students have paid for. But this is one that we did in Power Trader. We're taking a look at pre-market movement, pre-market volume compared to a previous day's close. And this trade was not a 1, not a 2, but a 3R trade. If you've been tracking along with our math, that's $750 that were made in the first couple hours of trading back on Monday. As the broader market gets a little bit more bumpy and confusing, we zoom in to a lower time frame and take a look at some of these trades that we can place on a 15-minute level. Come join me on Monday in Power Trader. It's totally free. The link is in the description. I'd be glad to explain how to do this in even more detail. Don't forget to like and subscribe to the channel for more market forecasts. And until the next one, blessings and favor on your trades.